Hi everyone, Daniel here from One Mortgages and Protection, your mortgage and protection insurance brokers. I hope you're liking the new video. I hope you're liking the content. If you do, please be sure to like, share and subscribe for all future videos and information on all things mortgages and protection related. Please take a look at our website by searching for One Mortgages and Protection or check us out on all social channels. Thanks very much and enjoy.
Hello, and joining us on the Mortgage and Protection podcast this time is Daniel Condren from One Mortgages and Protection to talk us through home mover mortgages. Daniel, welcome back.
Hi, well, yeah, good to be back talking about home movers and people moving home, wanting to see how much they can afford for a new house.
Yeah, of course. I mean, we've covered our first-time buyers, so it's now all about, moving again, moving on. So let's start with this question then, because it's quite important. I mean, what moving costs are, need to be considered as a home mover?
Well, there's quite a lot to consider of like how much your house is worth. So when you own a house, I would say most people understand how much their house is worth. So you've got to understand that the value of your current property and then think, oh, well, yeah, I want to move. So the things that you would go through is, what's my current property worth right now? Do I have a mortgage against it? Yes. And how much equity do you have in that property? And what always surprises me is the customer is kind of unaware of the total amount of equity in there, and it stopped them from wanting to move because they've had the mortgage for 5 or 10 years. And they may have forgotten that their mortgage has been coming down and reducing. So it's a great opportunity for them to think, oh, yeah, we can move. What's been stopping us? Why have we not moved? And in the current climate, interest rates are, they have raised slightly, but they're still at an all-time low and they're still very, very low. But yeah, it surprises me why people don't think, oh, yeah, we could maybe go to a bigger bedroom or have a bigger garden or want to buy that bigger house. So it starts with people wanting to move house. So what other costs have you got to consider? So yes, your equity that's in the house that would go towards your deposit of the next house. Stamp duty, so the government tax when you buy a new house is always a good consideration. Your estate agency fees, so to market your property and sell it, which does take a considerable amount of time, you've got to think, how much is that going to cost? And that's going to come out of my equity. And again, I remind customers that don't worry, you don't have to have a big bank of money to be able to cover all these things. All these costs are going to come out of your equity. So they're going to come out of the property that you already own. So don't feel you need to have all this money ready to potentially move and sell. If you are thinking of moving, visit a mortgage broker. They will have the skills and experience to understand how much your property is worth, how much is the mortgage that you've got against that, work out how much equity you've got, and then break down the costs that's going to go for the next property, as well as all the moving costs that's associated with that. Other costs include the advice fees, the broker fees for the broker of when you get the advice. And typically that's only payable once you make the application, once you put your property on the market and you move forward. It would be free to speak to a mortgage broker at first. It would be free to speak to any professional. It should be. Always check that. Please just check that first. To have a conversation about, I'm thinking about moving. I'm thinking about selling my house and buying a different one. What's my affordability? How much can I afford? So speak to a broker first. They shouldn't charge you for that 20-minute consultation to see what are the facts, what are the numbers, can it be done? And it should surprise you that yes, it can be done in most cases when you look at your income, how much you can afford. And it's important to say, Tessa, that when a customer first buys a house, they're first-time buyers. So on their employment curve or how long they've been working, typically they change jobs or they move jobs or get a pay rise and go through their career progression. So they earn more money. So they first looked at a mortgage when they were a first-time buyer or when they first bought a house. And more than likely, they've gone up the salary level, or they're earning more money, or they've been promoted, or they've got a partner now and there's two incomes. So your income typically goes up. So if people do want to move to a bigger house and do all that, then they're surprised to think, wow, we can move from a a 2-bedroom terrace to a 3 or a 4-bedroom semi-detached or a detached, and they're surprised at that. So if they've got the equity and they've got the income because their earnings have gone up, then it might be a good time to check, oh, I wonder what I can buy. And hopefully that would stimulate the market. And this year, there is not many houses that are coming onto the market or stock. And that's just maybe because the customer thinks, do you know what, we'll stay where we are. We know what we're paying. We're not going to do all that. But, my advice would be just always check what the rates are, what's the cost, how much equity do I have, and is it possible to move? And then once you know that information, then you can think, actually, it's not that much more that we can afford now, and we can afford that because interest rates are really low. And that would mean that you can get a nice bigger house, a garage, a bigger garden, a bedroom, or whatever that thing is that you really, really want, which customers typically want more space or bigger, up to the point where they can get a bigger house. So that's costs. So, and there's plenty of other costs, but again, the mortgage broker would and should break down and itemize everything so you're fully informed of how much everything's going to cost when you move.
Okay, brilliant. Yeah, there's mortgage protection, isn't there? Even down to your removal, transport and storage. But like you say, that would all be discussed, throughout the process. You've touched on deposit, of course. I don't know whether you just want to clarify again, because we've got a question here. What deposit do I need and how much can I borrow? Would you like to add to those at all?
Yeah, I always say the same thing. The bigger the deposit, the better deal you're going to have. So the more equity you've got, is good. So if you've been in a house for 10 years and you've paid down the mortgage, the likelihood is that you've got a big chunk of equity because you've been repaying your mortgage. So you're going to have a big deposit for the next house. Now, the next house typically is a larger price, a bigger premium, a higher price. So you're still working within those percentages of 10% is kind of a good starting point as a deposit. 15% gets you an even bigger deal. 20% and 25%. So if you've got 25% and above as a deposit, that would mean a great thing to get a good refixed deal. But on that note, when we talk about deals, I think we're going to come on to porting and how that changes. But what I advise my customers is understand your plan and what you plan and how long you're going to be at a house. It wouldn't really make sense to get advice of refixing in a brand new deal on a mortgage for 5 years, and then in summer, 6 months later, think, oh, I think we should move. Why don't we move? Let's up sticks and move. Now, that's not the worst thing in the world because you can stay with your current lender. We'll just check the lender that you're with for a term of what we call porting. So you can port the mortgage to a new house. But typically the new house is going to be higher in value. So the mortgage that you've got, you're probably going to need a bigger mortgage anyway. So what going back to my first point is always look at your anniversary of your mortgage deal, whether that's a 2-year deal, a 3-year, a 4 or a 5-year deal, and try and keep it to within line of your plans. And just if the deal is coming up and your mortgage is coming to an end, and we've done a video on remortgages, we're going to do a video on remortgages. So check that out. But when the deal's coming to an end, you just think, are we planning on moving? Do you think we want to move? That might be a good idea. Okay, so shall we look at that now while the deal is coming up to an end? Because no customer is going to want the potential charges that come with it. So these are called early repayment charges. So when you fix into a deal, commonly right now is a 5-year fixed or a 2-year fixed. If you're going to fix in for that lender, there's going to be a penalty to come away from that lender and sell the property. That's where porting comes in. So it's not the worst thing in the world. We can potentially port the mortgage to a new house, but always look at your anniversary of your current mortgage deal if you've got a mortgage. But there are some people that don't have mortgages. So these are called unencumbered houses, or these greats have paid my mortgage off and I don't need a mortgage and I still want to move. And they're even better because they've worked really well, or they've been lucky enough to not have a mortgage, and then they're going to move to an even bigger house and they've got all that equity there. You can look at that option as well. So you can still look to move and speak to somebody like us to see, well, what would a small mortgage be if I want to get a bigger house? So just because a customer has paid their mortgage off, you'd be surprised that they go, oh, I wonder, should we get a new house, or should we see if we can slightly move? And it's good, you can move. People change their cars and change their lifestyle a lot. So why would you not want a nicer, bigger home? Or the opposite to that is that you might want to downsize and move somewhere differently again. Would you need a mortgage? Would you need advice? And we would certainly still help that customer of understanding what the mortgage would be, if there is one. If there isn't, that's fine. At least you've been informed and you've been told of what is out there and what's available.
Yeah, definitely. And obviously you touched on porting there. So I think we'll skip the next two questions because you've kind of covered them in what you've just said there. Or how does the equity in my home affect my options? How does moving house affect your mortgage? What's the process? You've kind of given us a good idea, really. So let's go on to some of the porting questions then. So we've got here, can I increase the mortgage value when I port?
Yeah, it typically comes as a sub part. So the deal that you originally had taken as a customer, maybe a year ago, 2-3 years ago, and you're still on that fixed period, that part would still have the same expiry date, and you would move and put the security onto a new house. So that's what we call porting. So it comes from the old house and it's moved over and it's put onto the new house. And then if you did need more of a mortgage, a separate part, that separate borrowing or that separate part would be on a different contract, a different term, a different deal. So you'd have two deals that come off their fixed period, or if it was a tracker, or their period of the end of the deal at two different times. So it does get a little bit more complicated in checking your diary when the deal comes to an end, or when you're with that lender. And it kind of promotes that you're going to stay with that one lender for a long time then, which is not good for the customer in a way of thinking, I want to have the best competitive interest rate and I want to be able to move every time my deal comes to an end and really shop around. Now, if you do that and you do port, the likelihood is that you're going to stay with that lender, because every time that you try and move or go to a different lender, it will incur costs. And sometimes those costs can be more cost effective by moving to a cheaper lender, and it can make sense to move to a cheaper lender. But you've just got to understand, what's the exit fee? Is there an early repayment charge? Can that be, is it worthwhile financially to do that? And that's what the advisor would do for you and explain, there is an early repayment charge of this, we found out from the lender, and then what do you want to do at this point? Or I'll port my mortgage, please, and I'll port it over with an extra part. It's still good to always go back to the same lender and check what they're offering. But a customer wants the best deal, the most suitable deal, and then you just go accordingly with what advice you've been given on the most appropriate deal, and then you can still move. So that's good.
Yeah, that's brilliant. Yeah, because people have asked, how do I decide whether to port or to get a new mortgage? But I guess what you've just said there is how you would decide, I suppose.
Yeah, you have to understand what the cost implications of doing that are, and that's what the broker will do. They say, look, if you're staying here with this lender and we port it across with the extra amount on, this is what the new payment's going to be, and this is what the term is, and then versus a completely new deal and what's been changed. And that's really important to consider this, that every time that you do a new application and you borrow a bigger you borrow a bigger amount, or a new application, Tessa, you can actually change the term of the mortgage and the material parts of the mortgage. So the term can be shortened or lengthened. The deal can be rechosen, whether that's a 2 or a 5 year deal. Whereas if you stay with the porting option and you move over, you kind of stuck with what that lender says yes or no, and what their policy is. So that's it can be a good thing because you're going to save money, but it also can be a computer says no thing and a restrictive thing as well. So you've got to look, if the customer doesn't like the new property, the lender, not the customer, the lender doesn't like the new property or doesn't like your new circumstances because you've changed your job or something, then it's not an option to stay with the same lender, because they're going to say, no, you can't port, or you're not going to do that because you can't take the extra borrowing. And that sometimes really disheartens people when they want to move. They go, oh, well, my current lender said no, so that must be it then. Dream's over, we can't move, and that's fine. So the good news is, when you speak to a broker, you've got all the other options of every other lender. So just because your current lender says no, doesn't mean that there are other providers out there that would say yes. but is that worth it? If you've got an early repayment charge, typically, let's say, for example, of £1,000 to pay, but you've seen a dream home that you want to move into, and your current lender has said, actually, looking at your new income and looking at the way you've changed something, we wouldn't be happy and you can't afford the new mortgage, then oh, well, it must be the same everywhere. Then maybe the next lender's going to say that. And that's not the case. You're always going to check, well, yeah, I'm happy to pay £1,000 because it means that I'm going to get this lovely, amazing new house, new mortgage payment, new everything, new house, new garden, new garage, new bedrooms. Everything's going to be lovely and done. So don't feel that you are kind of at the lender's mercy that you're currently with. If they're not going to be amenable and check that you can move to a new lender, somebody else may do it. So always check. And that £1,000, yes, you might have to pay it, but sometimes you don't have a choice. Maybe you might think, you know what, I really want this, and I'm going to sacrifice that and pay the charge. But our job is to point out and show you what that is, and saying, right, are you sure? Because these are your options. Are you sure you still want to move? Are you sure you still want to incur those costs? Or do you want to stay where you are until the deal ends and then move? And most customers, impulsively, they say to you, do you know what? I'm happy with the fee. Don't worry, I'll pay the early repayment charge. I still want that house. Can you make it happen? And then that's fine. We can do that. Yeah. And you're like, yeah, of course we can. Yeah, we can do that. And then they're happy. We're happy. We've helped the customer move with the lowest possible fees. But of course, you should always check with your current lender whether they can do it. Is it more cost effective? Yes, they can. Fantastic. And then you wouldn't have to do that. But I've been to some lenders where we've tried to get extra borrowing, or we tried to do that, and they've said, no, it doesn't fit our policy. We're not going to do that. And then you're stuck because the customer still wants to move. They still want to do it. And then you point out the options and availability, and then they move over and they're happy. Everything's happy. Everything's good.
Okay, well, lots to think about, but like you say, there are options as well, and I guess don't get disheartened. We've talked a lot, haven't we, Daniel? Is there anything else we need to consider when we're moving home?
No, I don't think so. The current value is it, but most customers understand what their current value is. The houses, they know what they purchased it at, and they've seen their neighbours move. So just have a ballpark figure in your head. You don't have to get a true proper valuation, with a surveyor or even an estate agent. As long as you've got a ballpark figure of what you think the property is going to be worth, we can work on that, and then have the advice and options following that appointment, and then go from there. But no, that's it. I think we've covered quite a lot on home movers.
Yeah, definitely. Okay, well, thank you for that. Thank you for your time. Insightful as ever. As we always say, hopefully we've helped a few people out by listening to this. I'm pretty sure we'll catch you on another episode very soon. But you take care for now.
Thanks. See you next time.